Hey everyone, this is Kirk here again at Option Alpha. This is the members only video to round out the month of May here. The markets had a really good day to kick it off for the short week after Memorial Day weekend. Markets were up over 1% for the day, which is good. I guess if you're in the bull camp waiting over the weekend, at least there was no surprises over the weekend, which is always a good thing. What I wanted to do on this video tonight is go over some of the positions that we have, obviously, for all the members. And then what I want to talk about first is just kind of where my thoughts are on the market going forward. There's two kind of conflicting signals that we're starting to get in the market, which I really wanted to go over, and that's what the purpose of this video is tonight. So let's dive right into it here. We're taking a look at the S&P on my trading screen here at Thinkorswim. And what I have highlighted here in blue is virtually the end of QE2, QE1, where the Fed's quantitative easing program had ended. And you can see that right after that period, the market took a little nosedive. I think actually QE1 ended a little bit earlier in April. But regardless, right after the end of QE1, the markets were virtually flat before taking almost a 3-month nosedive. And that's actually when we had the flash crash and that whole time frame. But even if you take out the flash crash that one single day, the markets were generally down and the dollar was up. So that's what happened after QE1. Now, I've virtually said the whole time here that I think that that's basically what's going to happen after the end of QE2. Now, there's no real language that's been used about QE3. Of course, there's rumors in the market about it happening, but the Fed has been pretty adamant about not disclosing its hand on QE3. And even if it does, it's going to wait a little bit, and that's what it did the last time when QE1 ended. It waited a couple months. I think it waited like 6 or 7 months before they announced QE2. So I would definitely say that we're in for at least 3 to 4 months here of no word on any more QE programs, however many we're going to have in the coming months and years. What's really interesting about where the market's at right now, and this is why I wanted to go over the video, is that back in November, December of last year, we had a market that was trading slightly down, and you can see it was trading in downward fashion, and I'll just highlight it here with a little line. It was trading down, and it had broken out of this trend line that it was just kind of consolidating in for the better part of a month. Had a real strong breakout, and then from there it seemed to rally almost every single day, but slightly. There was the rate at which it was rallying was declined, but it was still going up very, very slightly for the better part of the next couple months. We almost got that same signal today, and I'd probably even argue that we got virtually the same signal where the market was declining, and then again today it had broken out strongly above this trend line. So whether we're going to get that same type of movement where the market just continues to slowly grind higher, I'm not sure, because the only thing that really, I guess, gets me thinking is that the last time that this happened was right in the middle of QE2. So the market knew the Fed was going to come in and buy up the market. But right now we're facing June, which is technically the end of the bond buying program. So I think that that's the real big conflicting signal that we're starting to see right now in the market. As far as our positions are concerned, for the SPX, we just have a credit spread at 1205, so that's really looking good. On the RUT, we're a little bit more positioned all over the place. We have 2 credit spreads below the market, which have been really, really good, obviously. So we've entered those positions as the market rallies away. That's great. We do have 1 position at 910, which is a little bit above the market. And of course, I would have liked the market not to rally as fast, but I can't have my cake and eat it too. I have positions on both sides of the market, so long as the market stays in between this range, I think we'll be pretty good. The RUT is definitely coming into some pretty strong resistance at this Fibonacci retracement level, so that's definitely going to help out going forward. For the iron condors, we have an IWM credit, or IWM iron condor at 89 and 74. The naked puts and calls, we have a put at 70, of course, and pretty much everything else is in put land. SPY 115, I think we have a position on the DIA at 105, and then USO is our other child, and we have positions at 32 and 28. You can see that those positions on the USO have been really, really good lately at 32 and 28. You can see that the oil markets have definitely seen a little bit of a rebound here as expected, and those are trending higher nicely. What I really like about the USO position is that it was so far below the market, and even though it's a small premium, the margin is really low, so you can get great returns on them, and they're really, really so far below the market for oil that's a hard commodity that I didn't think it was going to get down there in that quick a fashion. And you can see here on my chart that I was taking a look at the most recent drops in oil and kind of charting those out as far as days and volatility, and made a correlation and just to see how far, if it did drop, oil could go. And you can see that I was expecting it at its very, very worst to get down to 34. Both of our strikes are well below that at 32 and 28, so that's looking good. Silver has been on another rampage again, starting to move higher, obviously. I've said for a couple months now that, or at least not a couple months, maybe 2 months now, that after this little crash here, I think that the next leg is going to be just a bear trap. It's going to be a rally that kind of sucks everyone back into silver for the time being before it kind of keels over here. So that's something to obviously take into account as you're trading. Gold has been doing really good as well. Gold has been moving higher along with the other commodities. The last thing I want to take a look at tonight here really quickly is just the dollar index. This is the chart that I've been kind of really watching here, because as dollars continue to get weaker, equities will get stronger as well as commodities, obviously. So if we start to see some strengthening in the dollar in the coming weeks with the end of QE2, then equities and commodities could really take a little bit of a beating here. I've had this highlighted area of resistance a couple times on charts and videos, and again, so I'll point it out to members here, but this is going to be a tough area for the dollar index to get past, because you can see it's breaking major long-term lows, not only here back in December '09, but a little mini bottom in November of 2010. And then again, you can see the major break here just in the last couple months. So it's going to take some time to get past this level. But I definitely think that we've started to go in the right direction. Again, as with everything else that we're seeing, we see a breakout of this downward trending line, a very strong breakout. Now it's doing the natural retracement. So it could be heading lower, but it's still on the top side of this trend line here that you can see here in black. So if we do get a nice little bounce here in the beginning of June, I think it'll be easy for the dollar to take out these levels and continue to strengthen going forward. So as always, I hope you guys enjoyed this video, and please let me know if you have any questions or comments. I'll try to send out some more updates in email tomorrow and the next day, just to keep everyone up to date with what's going on in the market. As always, happy trading.